Hello everyone, hope you're doing well. Today we will learn here how to file income taxes for salaried individuals. But in order to understand the return filing of salaried individual, first we need to understand the basics of taxation. How many heads of income there are? So basically there are 5 heads of income: income from salary, income from house property, income from business and profession, income from capital gains, and income from other sources. Income from salary consists of those income which are earned from salaried income. For example, if you're working somewhere as and there is an employer-employee relationship, that particular income is known as income from salary. Now, what is income from house property? Income from house property is basically if you're earning any rental income from letting out any house property. So this is known as income from house property. This usually is residential house property. When you're letting it out, it is basically that only. Now coming to the third source of income, this is the income from business or profession. Any kind of business which you are doing that falls under this category of income. So there can be different kind of entities, for example sole proprietorship, partnership, private limited company, or a public limited company. So any kind of income from these sources of income would be income from business. Now what is income from profession? Income from profession pertains to like for example a doctor, a chartered accountant. If they are giving some kind of services, then in that case it falls into this category of income. Now, what is income from capital gains? Income from capital gains is when you are doing some share market trading, share trading, online trading, and then you're earning some profit from this source. Then it is known as income from capital gains. And the fourth is income from other sources. Income from other sources basically is any kind of income which is not falling into the above 4 categories is known as income from other sources. Now, income from other sources, what does it include? It includes, for example, interest you're earning from fixed deposits, or you're doing some small tuition center and earning small income, doing some small random work. Then any kind of income which is not falling into the above 4 categories would fall into the income from other sources. It also includes dividend income or income from lottery, gambling, and all these kind of income. There are few important terms which we need to understand when we are studying taxation. This without understanding these terms, we cannot we cannot go ahead and understand what how the taxation treatment would be done. So it is very important to understand the important terms. So some of the important terms are assessment year, previous year, residential status, and gross total income. So now we will go step by step and understand each and every definition. Assessment year. For example, we are considering assessment year 22 and 23. What does assessment year mean? Assessment year means the period starting from 1st April and ending on the March 31st of the next year. Usually the current year is known as the previous year, and whatever, like whenever we consider assessment, it is always 1 year ahead. So in case today we are in financial year 21-22, then assessment year will always be one year ahead of the previous year. So what is previous year? The previous year is the financial year immediately preceding the assessment year. Now coming to the definition of residential status. So there are 3 kind of residential status: resident, non-resident, resident but not ordinarily resident. So these three residential status is very important to understand, because the taxability of income would be determined on the basis of the residential status of the individual. So for residential status, resident means world. For a resident of India, the world income is taxable in India, and for a non-resident, only income which is arising or accruing in India, that is only taxable. However, for a resident individual, any person, any income which is earning whether in India or abroad, every food thing would be taxed in India itself. And coming to the third one, resident but not ordinarily resident, income accruing or rising outside India may also be taxable in India. So any income which is arising or accruing outside India may also be taxable depending upon the number of days which that person is staying in India. Now let's understand resident definition in more details. So resident is determined, as I told you, on the basis of the number of days a person is staying in India. So when can we call a person resident in India? We can call a person resident in India on the basis of his stay in India computed separately every year. So basically you need to do the calculation every year. If the below any of the conditions are satisfied, then a person is known as a resident of India. He is in India for a period of 182 days or more in the financial year. Or, please note that this is or. So if a person is staying 182 days or more in the financial year, or he is in India for 60 days or more during the financial year and has been in India for 365 days or more during the 4 previous years immediately preceding the relevant financial year. So if any of the two conditions is satisfied, then the person is known as a resident of India, and any income which he is earning from in any place, whether it is India or whether he's earning something, for example, abroad, then everything would be taxable in India on the basis of his residential status. Now coming to the heads of income, as I told you that there are 5 heads of income. Now we will study income from salary in a little bit more details. So what are the earnings which would be regarded as an income from salary? The definition mentions the meaning of salary as wages, pension, annuity, gratuity, advance salary paid, fees, commission, perquisites, profits in lieu of or in addition to salary or wages, annual accretion to the balance recognized provident fund, leave encashment, transferred balance in recognized provident fund, contribution by central government or any central government or any other employer to the employee's pension is known as salary. So there are different regimes which have come into place, and now there are 2 regimes. So which regime you need to follow, that we need to understand. There is an old regime and there is a new regime, and there are different rules and regulations for both the regime. We will go through them in the next slides. So new regime has no tax deduction and new tax rates. Comparison between the two slabs in the next slide. So now there is the new regime and the old regime. As we can see that there is a tax income bracket. First income bracket is income from 2.5 lakhs to 5 lakhs, and this the 5% taxation rate is there. In the old regime it was the similar thing. Income from 2.5 to 5 lakhs, it was 5%. Coming to the income bracket of 5 lakhs to 7.5 lakhs, the rate of taxation is 10%. Previously income from 5 lakhs to 10 lakhs was 20%. Income from 7.5 lakhs to 10 lakhs in the new regime is 15%. However, in the previous old regime, income from above 10 lakhs would be 30%. Income between 10 lakhs to 12.5 lakhs is 20%, and income between 12.5 to 15 lakhs is 25%, and income above 15 lakhs is 30%. So basically we see that over here in the old regime, the income above 10 lakhs would be taxable at 30%. So this is like over here you'll see that different tax rates are over here, but then there is also pros and cons of the new and the old regime, which we will discuss ahead.